Every chapter in this course fits on one card. Stay to the end, and I'll hand you Chapter 7's one table with every journal, every entry, and where each one posts. But first, a problem. Your store makes 1,000 sales this month. In the system you've used for 6 chapters, that's 1,000 journal entries, written by hand, one at a time. Nobody runs a real business that way. This is accounting information systems, special journals, subsidiary ledgers, and the one book that catches everything else. So what is an accounting information system? In plain English, it is how a business collects, processes, and reports its transactions. And you have been running one by hand since Chapter 1. You already know its 3 jobs. Back in Chapter 1, it was identify, record, communicate. Identify is collect, record is process, communicate is report. Same 3 jobs, new names. Watch a single sale travel through it. Collect. Nadia buys $900 of goods on account and a source document is born. Invoice 201, the proof. Process. We record that sale on one line in a journal, then post it to Nadia's own account. Report. That same $900 shows up as accounts receivable on the balance sheet and as sales on the income statement. 1 sale, 3 stops. And a good system follows 3 principles. It is worth more than it costs. It gets the right information to the right person at the right time, and it bends as the business grows. Here's the bottleneck. Every transaction lands in one general journal, and every posting lands in one general ledger. Beautiful for teaching. It collapses at volume. Accounts receivable becomes a single account holding 1,000 mixed-up sales. So when Nadia calls asking what she owes, there's no page to turn to. Her balance is smeared across the whole ledger, so accountants split the work twice. They split the journal by transaction type, and they split the ledger by customer. That's the chapter. Get this map in your head first, because students mix these 4 books up constantly. 2 jobs only. Books that record are journals. Books that sort are ledgers. And here's the good news. You already own half this map. The general journal is the book you have written in since Chapter 2. Every debit and credit, every adjusting entry in Chapter 3, every closing entry in Chapter 4, all of it went there. The general ledger is where you posted those entries, 1 page per account, and it is what your trial balance was built from. Those 2 are not going anywhere. What is new in Chapter 7 is the other 2. The special journals sit beside the general journal, one for each high-volume transaction type. And the subsidiary ledgers sit behind the general ledger, holding the customer-by-customer detail. Record first, sort second. Start with the subsidiary ledger. Here is the plain English version. Before any accounting words, you keep one big number for the whole group, and you keep a separate page for each member of that group. That is the entire idea. Now the accounting words for it. In your general ledger, the one you have used since Chapter 2, accounts receivable is a single line, one number. That single line is the control account. Some textbooks say controlling account. Same thing. Now take one customer. Just one. Nadia Corey owes us $900. $900. Where does her name live? Not in the control account. The control account has no names in it at all. Her name lives on her own page, in the accounts receivable subsidiary ledger. Marco has a page. Priya has a page. Think of a book. The table of contents gives you 1 line per chapter. The chapters hold the actual detail. And you will meet 2 of these constantly: receivables, the customer's ledger, and payables, the creditor's ledger. Now the golden rule. If you remember one thing from this chapter, make it this one. Plain English first. The pages must add up to the summary. That is all it says. Add up every page in the subsidiary ledger, and that total must equal the control account. Always. No exceptions. Let us do it slowly, with real numbers. It is the end of May at Cedar Company. The control account, the one line in the general ledger, shows $3,550. $3,550. Hold that number. Now we turn to the pages behind it. Nadia, $900. Marco, $2,000. He bought twice, so his page carries 2 debits. Priya, $650. Before I add them, guess. Do they tie? 900 plus 2,000 is 2,900 plus 650, 3,550. It ties, and here is why this matters more than it looks. If it had not tied, nothing on your screen would tell you. No error message, the books would look fine and be wrong. And when it does break, that is a gift, because the error is hiding in one ledger instead of the whole business. Tool 2. Special journals. Instead of writing a full entry for every transaction, you group transactions that look alike, record each on a single line, and post only the totals at month end. Most businesses run 4, and each one answers one question about your business. The sales journal records every sale on account, and it tells you what your customers owe. The cash receipts journal catches every dollar coming in, and it tells you where your cash came from. The purchases journal records everything bought on account, and it tells you what you owe your suppliers. And the cash payments journal catches every dollar going out, and it tells you where your cash went. 2 sell side, 2 buy side. Anything that fits none of these 4 still needs a home, and it has one. We'll come back to that book shortly. This recap builds just one of them, the sales journal. The full Chapter 7 lesson works all 4 line by line. Let us build the sales journal. One rule about what goes in it: sales on account only, nothing else. And remember, Cedar Company runs perpetual inventory from Chapter 6, so every sale carries 2 things: the price we charged and the cost of what left the shelf. Watch one line, then the rest are the same. Invoice 201, Nadia Khoury, $900. $900 is the price, and those goods cost us $540. That is one line. 1. Not 4 accounts, not a debit column. One line. Invoice 202, Marco Bellini, $1,200. Cost $720. One line. Invoice 203, Priya Shah, $650. Cost $390. One line. Now look at what is missing. No account names, no debit column, no credit column. If you came from Chapter 2, that should feel wrong. Here is why it works. Every single credit sale hits the same 2 pairs. Always the same. Accounts receivable, the control account with sales revenue at selling price, and cost of goods sold with inventory at cost. The names never change, so we write them once in the headings. The headings say it once, and 2 amount columns do the whole job. Posting happens in 2 rhythms, and mixing them up is the most common mistake in this chapter, one at a time. Rhythm 1. Daily. Each line of the sales journal is posted straight to that customer's own page in the account's receivable subsidiary ledger, and every customer has one. Watch Marco. He bought twice in May, so his page carries 2 debits, $1,200 and $800, and underneath them, his balance, $2,000. Nadia has one line, $900. Priya has one, $650. That is daily, and it touches the subsidiary ledger only. Rhythm 2. Monthly, you total the columns and post the totals to the general ledger. Debit accounts, receivable control, credit sales revenue, $3,550. Then, because we are perpetual, debit cost of goods sold, credit inventory, $2,130. Every day the customer pages. Once a month, the general ledger. Now the payoff. 4 sales, 2 general ledger entries. Make it 1,000 sales. Still 2 entries. That is the leverage this whole chapter is buying you. Here's the detail most students skip, and it separates an A from a C. The posting reference column. It's an audit trail. On the customer's page, you write S and the journal page, S1, meaning this came from page 1 of the sales journal. Cash receipts leaves CR, purchases leaves P, cash payments leaves CP. Back in the journal, a check mark means the line reached the subsidiary ledger, and account numbers in parentheses under the total mean the total reached the general ledger. Reading those marks is a whole job. Which brings us to the 3rd book. The general journal does not retire. It becomes the everything else bucket. A customer returns goods? General journal. You send damaged inventory back to a supplier? General journal. Adjusting entries, closing entries, correcting a mistake from March? All general journal. The rule is one line. If a transaction doesn't fit a special journal, it goes here. That is not a weakness. It is the design on purpose. Keeping the odd transactions out is exactly what lets the special journal stay one clean line each. Last piece. Before you close the month, you prove the books. 2 checks, and they are not the same check. Check 1 is about the ledgers. List every customer balance, every page in the subsidiary ledger. That list has a name worth knowing. The schedule of accounts receivable. Nadia $900, Marco $2,000, Priya $650. Total $3,550. Now compare it to the control account, $3,550. Tied. That is check 1, and it proves the subsidiary ledger agrees with the general ledger. Check 2 is about the journals, and it asks a different question entirely. Once the column totals are posted, do debits still equal credits? That is the Chapter 2 test, and it still has to pass. Then do exactly the same on the payables side. 2 checks. The ledgers agree, and debits equal credits. Miss either one, and you have closed a month you cannot defend. Pass both, and the month is proven. Screenshot time. The whole chapter as one routing card. A transaction walks in and the card sends it to exactly one book. Sales on account, sales journal. Cash in, cash receipts. Purchases on account, purchases journal. Cash out, cash payments. Anything else, general journal. Each stop tells you what it records and how it posts. Daily to the subsidiary, monthly by total. And underneath, the rule holding it honest. Every subsidiary ledger must total to its control account. Pause and screenshot it. This is the machinery humming behind every set of books you'll ever open, and now you can read it. If it clicked, hit like and subscribe so the next chapter lands in your feed. There's a full Chapter 7 lesson on the channel if you want every example worked slowly. Free practice exercises and notes at appliedanalyst.com. No catch, no paywall. And grab the free weekly newsletter, a stock market recap plus one options flow breakdown every week. Now go prove a ledger.